Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. We're going to discuss some of the key themes driving markets. These include the outlook for risk assets, European growth and the ongoing trade skirmish between the US and China. Mark, let's start with Europe, and after a strong showing in the last year or so, is the region still displaying that strong economic growth?
It is, but the pace of acceleration is slowing, if you will. So we came into the new year with sharply accelerating growth, leading indicators across the board at quite elevated levels. The PMIs that we like to look at up near 60, and 50 is the break-even rate for which you'd be expanding. So really quite significantly in excess of that. And what we've seen is that the growth has come back, the leading indicators have reduced a bit. So we're still growing in Europe, but the pace of growth has slowed. And the reason that's important is because whereas the acceleration in growth that we saw at the beginning of the year was a surprise to most investors, investor sentiment has really caught up with the fact that Europe is expanding now. And so if anything, although we're still growing in Europe, we've probably disappointed at the margin in the last few weeks.
And let's move over to volatility now. And after a long absence, this year has seen a return to choppier markets. Is volatility here to stay? And if so, is that an opportunity?
Yes and yes, I think is the short answer to that. So I think volatility is here to stay. We've got clearly heightened geopolitical tensions, and specifically we've got this trade war to sort of focus on, which has a potential to impact markets, and that's sort of leading to investor unease. And then in addition to that, what I just said about slowing slowing growth in Europe, perhaps disappointing investors, I think that's also leading to some uptick in volatility because investors' expectations had got to a certain level and we're now not meeting that. Of course, volatility is the friend of the active investor. We clearly have the opportunity to take advantage of those market corrections and market movements when we see them, to add to markets that we like and add to companies that we like and add to bonds that we like. So I think it's whilst it's unsettling for the end investor, at the margin it does help us active investors really help to outperform.
And moving over to the US, the rhetoric between the US and China has continued to surprise. What are your thoughts on this ongoing trade skirmish we have, and what are the impacts of this on markets?
Well, I think if it stops here, I think the impact on markets are relatively limited. It's quite targeted at a small number of goods, and clearly that will impact those markets, but it is quite targeted on a small number of issues. I think were the trade war to broaden out, then that has the potential to slow economic activity, particularly in North America, and it also has the impact of potentially being inflationary, and neither of those things would be particularly helpful. So if we stop here, I think we're okay. But if the heat rises in the situation, then I think that has the potential to be quite bad news for the global economy.
And we spoke about inflation the last time we met. Have you seen any more inflationary signals coming through, and if so, what might they be?
We've seen some additional wage pressures come through at the margin, not just in the US but also in Germany. We've seen the oil price rise. I mean, that potentially is a temporary thing, but nonetheless it is inflationary. And around the edges we've seen some other modest signs of inflationary pressure. And clearly what I just said about the trade war also has the possibility of being inflationary. So the tension's risen a bit from an inflation perspective. It's still not something that we're massively concerned about, but certainly the pressures have risen and the risks have risen, and as we've seen, the bond yields have risen as well in response to that. So markets have been driven over the last 10 years in large part by the fact that we've had low interest rates, and that has underpinned the valuation of other asset classes. So it's critically important that we don't see an uptick in inflation and we don't see a big sell-off in the bond market.
Now, at an asset allocation level, Mark, you still favour equities and UK property. What's the ongoing case for these?
Well, within equities, the growth that we've been talking about, even if it is slowing a bit at the margin, has really helped drive corporate profits, and we've had a very good earnings season. Corporate profits have largely beaten expectations, and valuations for equities don't look demanding. The profits have really helped bring down the valuations. So I think there is still a strong case to be made for being overweight in equities. Property, you still got a very strong yield in commercial property in the UK, and again that's helping to underpin valuations. Property yields in excess of 5% versus a 10-year bond yield of about 1.5% means that's a really quite attractive income pickup from that market. So again, remains attractive from an asset allocation perspective.
Mark, thanks very much.